Yo, my name is Sebastian Savela. So you do some research about the different investing options out there and you decide you want to invest in real estate because of the returns you could get, the control you have, and the tax benefits. So the reason you invest in the first place is to make more money. And in real estate, there's 4 basic ways, and that's cash flow, appreciation, amortization, and tax benefits. So I made a video explaining those 4 different ways. So if you want to learn more, check the link in the description below. So in general, whether you buy an investment property or not is going to mostly depend on cash flow, which is the amount of money that is left over after all your expenses. So you want to know that your cash flow is positive, which means that your property is making more money than you're spending. So you don't have to use your own money to keep the business running. But how do you determine cash flow? The formula for cash flow is pretty straightforward. So it's basically income minus expenses. Now, before I break those down, there's a couple of definitions that you need to know first. So I'm going to define a lot of technical terms, so you might want to grab a pen and paper for this one. Gross scheduled income. So if all the units in the property were occupied and all the tenants were paying rent, then the total amount of money that you get is the gross scheduled income. By the way, the rent is not the only type of income that you could get. So you could charge money for a parking space, or to use a washer and dryer, or even to rent a storage space that you have in the property. Vacancy. So whenever one of the units is not occupied, you have a vacant unit. And when you have a vacant unit, you're not making any money from it. So you want to try to minimize vacancies as much as possible. Most properties experience vacancies at some point or another. And it's a percentage of the total income that you would have gotten if all the units were occupied on an annual basis. So it's a percentage of the gross scheduled income representing how much money you've lost. Gross operating income. So that's the income that you actually get. So you get it from subtracting the vacancy from the gross scheduled income. Okay, quick example. You have a 3-unit property and they rent for $1,000 a month for each unit. So your gross scheduled income is $3,000 a month, or $36,000 a year. Now say that one of the units was vacant for 2 months out of the year, so you lost $2,000. So your gross operating income is then $34,000. Now, if you wanted to calculate the vacancy rate, you would take the $2,000 that you lost and you divide that by the total amount of money that you would have gotten, which is $36,000, and you multiply the whole thing by 100 just to get a percentage. And in that case, your vacancy rate is 5.5%. Operating expenses. Now those are expenses that you make to operate the property, to keep it functioning and to keep making money. So expenses like taxes, insurance, repairs and maintenance, utilities, lawn care, trash or snow removal, and so on. Note that I said expenses to operate the property. So the money that you spend on a mortgage is not an operating expense because you don't need to pay the mortgage to operate the property. Also, if you wanted to add additional square footage, like add another room or another floor, or remove a wall to make a room bigger, replace the roof, or update the electrical or plumbing, these are all called capital expenditure, or CapEx. They are not necessary to operate the property, so they are not operating expenses either. And then we get the net operating income, or NOI. So the NOI is the difference between the gross operating income, so the income that you actually get, and the operating expenses, which is all the money that you spend to operate the property. The NOI is very important to understand. So when you're buying an investment property, you're not buying it because of how it looks or how it makes you feel. You're primarily buying it because of the income it can produce. And the NOI is exactly that. It's the net income that the property generates without accounting for mortgage payments or capital expenditure. So the net operating income is how much the investment is making you on an annual basis. Once you understand these terms, we can now go on to calculate the cash flow. So if you're one of those people that have been aggressively saving and have enough money to pay cash for a property, which is a great position to be in, and you didn't make any improvements, the NOI, or the net operating income, that's your cash flow. That's money going in your pockets. Now, if you had any capital expenditures, you would just subtract that from your NOI and get your cash flow. Now, I feel like most people, when borrow money from a lender, you take your net operating income and you subtract what you pay for your mortgage and any capital expenditure. What's left is your cash flow. Now let's bring all of this together. So using our 3-unit, $1,000 a month per unit example as before, say that we didn't have any vacancies and we didn't make any improvements. Now say that our operating expenses came out to be $1,500 a month and our mortgage payment was $1,000 a month. Let's calculate our cash flow. First, we could get our gross operating income, which is the gross scheduled income minus vacancy. So in this example, the vacancy is 0, so our gross operating income is $3,000. And then we could get our net operating income, which is our gross operating income minus the operating expenses. In this case, it's $1,500. And we could finally get our cash flow, which is the net operating income minus any debt service minus any capital expenditures. So in this example, a debt service is the mortgage, which is $1,000, and we didn't make any improvements, so no capital expenditure, so it ends up being $500. So that's how much you'd be making on this property. Again, if you had any vacancies and or any capex, you would just subtract that. So if you didn't notice up until that point, the cash flow that we just calculated, that's the cash flow before taxes. Uncle Sam is always watching, so he definitely wants his share. So if you wanted to know what the cash flow is after taxes, you would first need to figure out what the income taxes are from the property. You would get with a licensed CPA to calculate your taxable income after all the write-offs and multiply that by your tax bracket. Your new cash flow after taxes now becomes your cash flow before taxes minus income tax. Now you might be thinking that's a small amount of money that you're making every month, but that's because you're not accounting for all the returns you get. If you're house hacking, you could potentially not pay any money for housing. That's $1,000 plus that you're able to save. You also have other people helping to pay your mortgage. So they're building your equity and growing your wealth every month. Then properties tend to appreciate over time. If you're buying for the long term, whether there's a recession or not in the short term, the value of the property will increase in the long run. And finally, that tangible income from the cash flow is just from one property. Because you're able to save money on housing, you're able to save even faster to buy more properties. Like who knows how many properties you'd be able to get in 10 to 15 years if that's the direction you want to go. Maybe you can accumulate enough assets where your total cash flow after taxes can surpass your regular living expenses. And that's one way to reach financial independence. So there you have it. That's all I got for today. If you think this video was helpful and want to support this channel, please like this video or subscribe if you haven't already. And don't forget to share with a family or friend you think might be interested in that type of content. Thank you guys so much for watching, and I'll see you next time. Peace.